So one of the elephants in the room is the yield curve inversion. And there's obviously a bunch of different yield curves. So for people that aren't familiar, I think a lot of people are because it's so commonplace this time of year. But basically, when you look at a long duration treasury and you look at a short duration treasury, normally the long duration treasury has a higher yield because you're lending money for a longer period of time, and so it comes with a higher yield. You're locking up capital for a long period of time, although you can sell the security. But shortly before recessions, the market starts to anticipate that the short end is going to get cut at some point in the next few years, and therefore they end up being more willing to buy the long end of the curve. And it becomes kind of a self-fulfilling prophecy because then lending has trouble working when you have the long duration um, interest rates below short-term interest rates, because the whole lending model, the whole banking model is basically duration transformation. You buy, you basically, you get capital from the shorter end, the lower interest rate end, and you lend it out at longer time frames for higher yields, and you manage your liquidity profile. And so when you get a yield curve inversion, that whole thing just becomes less profitable, and you get kind of almost like a self-fulfilling prophecy. And specifically, it's the 10-year um, and 3-month difference yield curve that has the most published studies on it. A lot of people cite the 10-year, 2-year, but the 10-year, 3-month is the one with more overall, a better track record overall. And I think it's something like 8 recessions now where it inverts before the recession with no misses and no false positives either. So some other yield curves have had misses, have had false positives. That's the one that had the initial studies on it and has like a frightening track record, at least in the US, right? So if you look internationally, you get different situation. This is a US phenomenon, especially, and it's just partly because we have such specific capital markets and the world reserve currency. And so most signs are pointing to a high probability of recession sometime in 2023. And so we're kind of in a disinflationary cycle where we had this huge run up in money supply growth. We had a huge run up in CPI with a lag inflation. And now with the Federal Reserve hiking interest rates, that's slowing down the housing market. We see the manufacturing purchasing managers index roll over. It's one of the most important macro charts you can look at. Is like the sine wave of economic growth and contraction. If you overlay Bitcoin on top of that, you get a better predictive model than the halving cycle, for example. Basically, rising liquidity, rising risk on economic activity. Bitcoin's usually doing pretty well. When you have falling PMI, falling liquidity, risk off, generally you have Bitcoin doing pretty poorly, either flat or down. And so right now we're in kind of that contraction environment. A last point I would make, well, then there's also the whole China reopening thing, right? Because that can throw a curveball into inflation, energy, commodities that have been coming off their highs. That would be probably inflationary to the extent that they open and do significant stimulus. So I think over the long term, their demographics have peaked, and so their overall growth rate is not going to be the same that it was over the past decade, especially in real terms. And their level of commodity usage, at least the commodity growth rate, is certainly going on a different course now. But their flights have been below trend for like 3 years now due to these just rolling lockdowns. Their auto fuel use, all of that could tick higher, and they can get higher crude imports in an already tight market if they were to decide to just open up and just go hard on it. So there's big questions like to what extent are they going to open up? Over what time frame are they going to open up? Like how gradual are they going to be? And are they going to couple that with a kind of a fiscal boost to really kickstart things? Or are they going to kind of just come out of the gate slow? So those are the variables to watch. Basically, the oil price going down has occurred with the U.S. drawing down a strategic petroleum reserve and with China holding back some of its own demand, essentially. And so the question is, what happens when we get to a point where the strategic petroleum reserve is no longer drawing down, and if China just goes back up to their prior level or near their prior level of flights and auto usage, let alone growth, let alone if just a higher percentage of population gets automobiles, air conditioning, they still have a low per capita GDP and low per capita energy use compared to the Western world. And so even if just population's flat to down, if they just, increase from, say, I think the numbers I don't have in front of me, something like they use like a third of the energy per capita, or a third of the oil at least per capita as the United States does. If that goes up to half, that's still an uptick, let alone what's happening in India, That's where there's better demographics, let alone what's happening in parts of Africa. Again, that's where better the demographics are. Um, and the last point I was going to make there about macro is that the the impact we've seen on like the Nasdaq and other assets this year, a lot of it was valuation contraction. So as interest rates have gone up, you can no longer use like zero to price your long duration unprofitable tech stocks or even your profitable tech stocks. And so there's been this valuation contraction, and that's pushed down most assets. And a lot of people are worried about what would happen to, say, Bitcoin if you had a recession next year. And obviously that's somewhat uncertain. We don't know for sure. But I think a lot of that's going to be driven by earnings. Going, say, flat to down, rather than just ongoing valuation contractions. Obviously, when the dollar is going straight up, the dollar index, and you're getting a higher rates and you're getting a valuation contraction, that hurts things like gold and Bitcoin too, even though they don't have profits. It's just kind of it's hurting their relative attractiveness compared to the dollar. But that if you encounter the next part of the cycle where you have less harsh monetary conditions, or at least the rate of change is less harsh, but then you have just ongoing weakness from equity earnings, corporate earnings, you can potentially get a decoupling where things like gold or Bitcoin do okay, maybe not great, while stocks are still, or at least some sectors are still doing very poorly. So I think people should not assume necessarily that if the stock market goes down, that Bitcoin has to go down. Kind of a similar thing happens where they assume that if the S&P 500 goes down, the emerging market index has to go down, which is not necessarily the case. I mean, for example, Brazilian equities did way better this year than the S&P 500 because there's specific reasons why the S&P 500 is going down and other assets are able to either chop along sideways or go down less or go up somewhat. I think that anything you can do for the network is good. I mean, I think especially the points where Bitcoin is currently not the strongest, like privacy fungibility. I think any work there is very good for the network. I think educating and separating the difference between Bitcoin and a lot of these coins that can just be created out of thin air is very important. So I think anything that you can do to have the media not lump those together is important. I think having people understand how Bitcoin uses energy and how much it uses
Yes.
relative to total energy produced, how it specifically, just financially seeks out wasted energy as a matter of, just just economics. I think all of those are very helpful. And one thing the way Corey describes it is that Bitcoin is inevitable, and but obviously there's like a hard way or an easy way to get there. I generally phrase it a little bit differently, but kind of a similar way of thinking, which is essentially that I prefer not to think of anything as inevitable because I think that can lead to complacency, and instead it's like, okay, it's just this profoundly good technology, this profoundly important network, and let's not mess it up. Let's put it to the best possible use, decouple it from casinos and just short time preference behavior, and focus on what really matters, which is payments and savings and things like that for 8 billion people in the world. So it's essentially the same message, more or less.